Without a full-time job can seem very difficult for a lot of people. And basically, every single person I've ever mentored in my coaching program has always had a full-time job. They've had engagements making it difficult for them to basically stay on the chart every single second of the day. But in this video, I'm going to share with you a very simple step that I teach a lot of them to use. And following these steps exactly how I outlined it, has helped a lot of them achieve great success in their trading, help them get funded. And I'm going to share those simple steps in this video. The first step is for you to understand the overall market direction. And in order to do that, you just have to basically go off the bigger time frame, 3-month time frame, 6-month time frame, 12-month time frame to understand the directional bias. Are we bullish or bearish? I always teach them to trade with the trend. Don't ever try to trade against the trend. And in this case, the overall trend, we're using Bitcoin as a point of reference. In this case, the overall trend is bullish, consistently creating a higher high and a higher low. Another higher high right here and a higher low because already we've broken above this previous high and closed above it as well, which confirms to me that's a break of structure. So price will potentially be looking for support and then a potential continuation to the upside. And right there you can see an inefficiency. So first step, derive the overall market direction, overall market structure. In this case, is bullish. So we're looking for an opportunity to buy. Now we'll start to scale down to look for opportunities, to look for a buy setup. Now, if we scale down to this daily time frame, you can basically see we had this move to the downside before an expansion to break that structure. The second step, we just draw our Fibonacci from the last move to the downside before an expansion, last move to the downside before an expansion to break structure. We draw our Fibonacci from that low to the overall high to derive our extreme discount. And right here, you can see our extreme discount resting right here. What we want to do is once price is inside this extreme discount zone, we want to look for a potential buy to go to the upside. And we'll be hunting for a low resistance liquidity. It could be an inefficiency or a low resistance liquidity, low hanging fruit area. And in this case, on the weekly, you can see we have an inefficiency resting right there, which is going to be our target. We're not targeting the overall high in this case because there's still potential room to the downside. Price could want to fail. Now we could continue to the upside to run these highs because this is low resistance liquidity. But in this video, I'm just going to show you simple steps to get into trades. And in the next video, I'm going to talk about my overall bias, what I'm anticipating to see overall in Bitcoin. So stay tuned for that one. So first step, understand the structure. Where's the market going? Second step, know which key level to draw your Fibonacci. And as you can see, this is the key level low. This is the low, this is the high. And then you anticipate for price to come into the extreme discount. Once it's in there, what you want to see is a 30-minute shift of market structure to the upside. And now we go to 30 minutes time frame and see, and on 30 minutes time frame, you can basically see clearly on 30 minutes time frame how price created a high, created a low, and then eventually we broke that structure. The moment we broke above this high, that's giving you the telltale signal to get ready for a buy. Which area do we buy from? This was the last downclose candles before an expansion to break that 30 minutes high. You can see that very clearly. This was the last downclose candle before an expansion to break this key level. Now, what I usually do is I set my entry at the bodies of the candle, stop loss, this low right here. And as you can see that very clearly, price came into that key level. Remember our target, like I said previously, our target is the weekly inefficiency. I outlined that in the beginning. And as you can see, price came down, mitigated the bodies of the candle, played around there for a little bit, came back in deeper, and then went back to the entry. And now we're seeing price expand to the upside. and then straight to the upside. This kind of move, it gives you opportunity to throw a stop loss to this low and then take profit hits. You can see that very nicely. So this is the 1:1.65 risk to reward ratios. And in the next videos, I'm gonna make and show you how I also get re-entries in here, right here. So how I do get re-entries using the smaller time frame, like 4 minutes time frame. And as you can see, this was the last down close candle before this expansion. And if you're looking down here, you can see the only place that we have an inefficiency within this leg here, the only inefficiency we have is right here. You can see that. I'll just show you how I get re-entries into the market using the smaller time frame in order to maximize my reward. One trade, first entry right here, second entry. Now this inefficiency restaurant right here, what I do is I want to see price mitigated and I want to see a 4 minutes break of structure. If I see a 4 minutes break of structure after this mitigation, I'll look for a second entry. And let me show you what I mean by 4 minutes shift of market structure. So if we go to the 4 minutes time frame, you can see clearly right here, price created a high here, created a high, created a low, and then broke structure. Right here we broke structure. The moment we break this structure on the 4 minutes time frame, in as much as I know that price will potentially 70% of the time it will hunt for this last down close candle before expansion to break structure. In as much as I'm anticipating for price to come into it, you can see how it came in and tapped it, but I wouldn't put my entry right there when I'm entering in a 4 minutes time frame. If I'm trading in a 4 minutes time frame, I usually just use the high that got broken as my entry and I use the overall low as my stop loss. The reason I do this is because different brokers are going to offer price at different levels. So instead of me trying to play profit, I just want to play being a risk manager. You can see basically if you had used here, price would have come down to activate you really well. But I never use that because I've seen a lot of cases where I've missed out on really good trades that delivered 1:10, 1:15. The reason I missed out on those trades was because I was trying to be too precise, putting my entry right here on the smaller time frame, and then price eventually tapped it, but it didn't activate me due to probably spread or whatever. But personally, what I do is to use the high and never use the last down close candles when I'm entering in the smaller time frames. And I've already outlined why I do that. And I tell all my mentees, don't ever use that smaller time frame last down close candle. Target remains the same. And as you can see, this one is to 6. So you can see basically one trade delivered two setups. One is to 1.6 and one is to 6. So if you add them both together, let's say you're risking 1% per trade, the two trades would deliver 7% profit already, and take profit remains the same. So you can see basically this concept takes like 10 minutes. So it's going to take you 5 minutes to basically put an alert here. Once you see price coming down into the extreme discount, it's going to take you less than 5 minutes to put an alert at the high. The moment this high gets broken, it's going to take you 5 minutes to identify this last down close candle, put a limit order there. And the moment you put a limit order there, you can as well see this inefficiency here resting within the range low and this range that broke the high. This inefficiency, just mark it up and put an alert there and move on with your day. The moment price comes in here, activates you, and then you're just watching it doing your thing, and comes in here deeper, tap in, and you hear that alert go off on your phone. All you need to do is look for this high. The moment this high gets broken, this one's going to take you probably 2 minutes. The moment this high gets broken, set an alert, move on with your day. The moment it gets broken, put an alert here, stop loss here, move on with your day, allow price to do its thing. And you can see basically after you're done with work, you come back to make the 7% profit in your bank, in your trading account. So far you can see that how this concept is playing out, and I've made several videos explaining this. And if you go through all those videos that I've made explaining how you can trade with a full-time job, you'll have a better perspective of how this strategy works. And if you need help or support in me explaining it one-on-one basis with you, or making several videos about it, just feel free to drop a message in the comment section, or you can feel free to contact me privately, and I will give you all the support I can. So I appreciate you for tuning in and watching from the beginning to the end, and I'll talk to you in the next video. Have an amazing day, everyone.